From New York City for our viewers worldwide, I'm Vonnie Quinn. Bloomberg Real Yield starts right now. Coming up, the Federal Reserve cuts rates for the first time this year, triggering a jump in bond yields across the curve as some investors perhaps expected a more dovish outlook. Meanwhile, credit spreads tighten even further, now sitting at the lowest level since 1998. We begin with the big issue. The Fed makes its move.
This is a Fed that locked arms.
25 basis points is not going to solve what ails the American economy.
This is all about risk management.
Don't fight the Fed.
And it doesn't really foreshadow what's going to happen going forward.
It's really clear that Powell corralled the cats.
The Fed basically has a split committee right now.
This is a committee that has to think about the long run.
The 10-year yield remains anchored near 4%.
We have not seen the steepest in the curve.
We're still looking at a steeper curve as we go forward.
We're all kind of hot and bothered by this move, but the truth of the matter is we're not in neutral territory yet.
The next decision is going to be a hard one, and the next press conference is going to be even harder.
So let's look at the most Fed-sensitive part of the curve and the week that was, the two-year yield for the week. And it's telling you that markets are readjusting for perhaps a less aggressive rate-cutting cycle. I mean, it's just a few basis points, but these are, important basis points when you see what the Fed had done and what happened during the week as investors sort of rethought maybe the chair's comments in particular, maybe not so much the statement or the actual 25 basis point cut. Let's look at the dots themselves on the Bloomberg, though. It gives us a picture of where the voters on the committee see the rates going in future. So if you look at this year, we had a nice group of people that maybe thought that they were doing the right thing. There's going to be 2 more cuts for the rest of the year. But there was all these people, another 9 people that thought maybe 1 or fewer. And then, of course, he's claimed it now. This is the new Fed Governor Myron confirming in the last hour that he is the low dot for 2025. But I wanted to point to 2026 because this is the picture we're looking at for 2026. Would not want to have to be forecasting into that environment. Well, again, Chair Jay Powell saying the central bank decision was a risk management move.
I think we were right to wait and see how tariffs and inflation and the labor market evolved. There wasn't widespread support at all for a 50 basis point cut today. I think you could think of this in a way as a risk management cut.
Joining us now is Stephanie Roth, Chief Economist at Wolfe Research, and Matthew Diczok, Head of Fixed Income Strategy at Merrill and Bank of America Private Bank. So, Matt, let me start with you here in studio. Powell also said there are no risk-free paths now. It's not incredibly obvious what to do. Very, very difficult position for the Fed chair to be in. Are there 2 more rate cuts this year?
Definitely not clear what to do. So 3 sort of key points from the meeting. First of all, to your question, Powell, this is his committee still. That is the first and most important point from the meeting. He did get everyone on the page he wants. But the second main point is, and you showed it in the dots right there, it's a close decision. It was only 10-9 for that 3-cut baseline. So there are 9 folks who think there should be no more cuts this year. In fact, 1 folk who didn't think there should have been a cut at this meeting. So the baseline's 3 cuts. We believe at Bank of America there's probably 1 more cut this year is likely. But the important third point here is you see the consensus is very frayed. Although they got behind Powell to show unanimity, it is not really that way behind the scenes. They are not really at a consensus at all. There are a lot of dissents behind the scenes.
So you're going against the grain, really, saying only 1 more cut this year. Is that why yields are backing up, or has it something to do with the Bank of Japan moves today?
So it's our belief, and again, it's coming from Claudio Irigoyen and Diczok, our head of economics research on Bank of America research side, that it's likely, if you see the Frayed consensus, we're not going to see enough improvement on the inflation side to justify those 2 more cuts. Now, again, we do acknowledge the market has 2 more cuts priced in. And so we're not going to get really too worried. Is it 1 this year? Is it 2 this year? We think there's going to be some volatility until the Fed has a clear consensus as to what they want to do. If that volatility leads to any sort of drawdown asset for prices, that might be an interesting time actually to sort of add to risk if it creates a little volatility for us.
Stephanie, let me come to you on that. What do you see at Wolfe Research for the rest of this year and into next year where it's a lot murkier?
Yeah, so we agree that it's likely to be fewer cuts than what's in the price, and that's perhaps one reason why the markets are reacting the way they are with rates moving higher, because Powell pitched it as insurance cuts. And our expectation is we'll see better employment data in the next couple of months, And then that will show that perhaps there's less downside risk to the economy. So our expectation is we'll see some upward revision to the August payrolls print. September could come in okay. And then your 3-month average in payrolls is a lot less concerning. And then the focus can then shift back to inflation. So the economy's largely okay. Consumer spending appears to be consistent with that. And that's one reason we think that rates should continue to trend higher throughout the course of the rest of the year.
Stephanie, where is your confidence in the labour market, given that the Fed chair himself is very confused about what's going on? He talked about supply going down because of immigration, but also maybe because of AI, but also demand is going down. And in previous meetings, he has said it's a confusing labour market.
Yeah, and it is a confusing labour market. So here's what we're looking at. First of all, when you look at the data in the past couple of summers, you've seen weakness in June, July, August. That, again, appears to be the case. There's seasonal problems in the data. August historically tends to get revised up, like I mentioned earlier. Then when you look at other measures of the economy, it doesn't suggest one where the labor market is falling apart. You don't typically sit here with 3-month average payrolls running in the 20,000 range with an economy that's largely weak. So our expectation is that, yes, supply and demand have come down into better balance, but perhaps we're not sitting at a roughly 20,000 run rate. And then when you look ahead, we have fiscal stimulus becoming positive, you have financial conditions which have eased, and then tariff uncertainty which has faded. That just suggests that the economy should be a bit better from here.
Well, so if neither of you is all that concerned about the labour market, then perhaps we should be more concerned about inflation, in which case is the Fed doing the right thing at all?
Well, so the concerns on inflation are interesting. Obviously, the Fed's target is officially 2%. But clearly, they don't have a lot of concern about that. We've been 5 years now where we haven't been anywhere close to that 2% level. And actually, that probably makes sense. You go back to 1914 when the BLS started counting CPI data, the average inflation rate's been about 3.3%. It was between that 2 to 4, average above 3% level in the 80s and 90s when the economy was quite good. So people ask me all the time, what if they default on the 2% target? Well, by de facto, they've already kind of not stuck to that 2% target. But that's okay. Nominal GDP, earnings, there's really no empirical data in the U.S. that you need to have a 2% inflation target. Running a little bit higher than that 3% is what we've done for various periods of financial history. The market is getting that sense now. It's better for the Fed to be more focused on maximum employment, helping the consumer, keeping businesses going, to Stephanie's excellent point, and getting labor supply and demand in balance, than it is to have this artificial target getting down to 2% when there is not a zilch evidence that it should be a 2% target.
Stephanie, what is the curve telling you right now? Does it move even more next week? Because in the last 10 days or 10 sessions, I mean, we've seen, a 1.5 round trip, really.
Yeah, and I think we could continue to see that. Our expectation is the 10-year moves back towards 4.2%, somewhere between 4.2 and 4.4, which is roughly the trading range that we've been in. That's kind of where we see fair value. And that could move kind of markets more broadly because it's been a dramatic shift since July. So when we're thinking about the sort of backdrop from here, it's one where the narrative could completely shift somewhat upside down, focused more on inflation. And while we are been running at 3%, the Fed does believe that a lot of it's tariff related. I agree with that. You've seen goods prices drive about 30 basis points of the upward move in core PCE. That's the numbers that Powell alluded to as well. So we're talking more about fighting 2.5% inflation, which is perhaps something that's more palatable than certainly the 3% today.
Yeah, you just saw the 2-10 spread there moving from 49 basis points or so to about 55 basis points. It doesn't seem like a huge move, but honestly, it is. So with political pressure from the White House, Fed Chair Jay Powell also spoke about various other things. And we're back with Fed Speak as well. We had former St. Louis Fed President Jim Bullard on surveillance this morning. And he had this to say, which was interesting.
I thought the Fed's decision was a good one. This looks like a sequence of 3 moves in a row through the end of the year. Non-farm payrolls is kind of the key number for the Fed, so I think that made them a little bit nervous. I think that tilted things toward a little bit more dovish policy.
Matthew, I wanted to ask you this because you mentioned a moment ago how the chair has the committee around him. If Bullard is saying this, he would have been also in Powell's camp. Has he just lost in the running to be Fed chair, and Waller the same, and also Mickey Bowman. No one else dissented except Myron that we know of.
It was very interesting to see, again, that the committee did sort of rally around Powell. That's very important. Whether that takes them out of the running, I certainly can answer that question. It's going to be an interesting race, we'll say that. We would make the comment that there have been concerns about Fed independence, and those concerns are real, and we do want an independent central bank. But we have to take a broader view. Historically, tension between the executive branch and the Fed chair is not unusual. LBJ brought his Fed chair down to his ranch in Texas, got physical with him in a one-on-one, tried to get his rate policy. President Truman actually called Tom McCabe, his Fed chair, at home 2 weeks before Christmas in December to argue for his rate policy. So presidents arguing with Fed chairs is part and parcel of American financial history, like it or not. This is interesting because the Supreme Court has recently carved out the Fed as a unique institution with an interesting history. So if they do get a case in front of them about what is cause, when can an executive branch fire a governor, they might actually more clearly delineate and define how it's unique, and actually may help solidify Fed independence. So while we think Fed independence is a concern, the Supreme Court, if they get a look at this, might actually solidify more Fed independence, which is very important for markets, and the markets might be seeing that.
Well, yeah, and Stephanie, to add to that, let me ask you, I mean, traditionally, there is only one dissent ever. I think there was one meeting recently where there were 2 dissents, but it has been the case that if there's going to be a dissent, it's a sort of a symbolic dissent, right? Is there any chance that that's what happened this time?
I think it was a symbolic move that all of the Fed governors came in line outside of Myron. That tells you that Fed independence is quite durable, even though there are 2 members who are vying for the chair's job. This kind of tells us that they're willing to get behind the Fed independence when it really needs to be the case. There were concerns that when it comes time to reappoint the regional Fed governors, that there would be, or presidents, that would be an issue in terms of the board potentially vetoing that. I think that this pours cold water on that idea, and the Fed independence is a lot more durable than many feared, at least a couple weeks ago.
All right, fascinating discussion. Our thanks to both of you. That is Stephanie Roth there of Wolfe Research and Matthew Diczok of Merrill and Bank of America Private Bank. Some breaking news now. The Trump NY Times lawsuit has been dismissed for now for being too long. The judge in the case said that Trump can refile any NYT complaint with direct claims. So once again, the Trump $15 billion defamation lawsuit that he took out against the New York Times just days ago has been dismissed for now, and the president can refile, should he wish to, with more direct, short, plain claims. That's a quote from the judge. Short, plain, direct claims. Up next, the auction block. Risk premia on U.S. investment-grade corporate bonds making a new multi-decade low. We'll talk credit next. This is Real Yield on Bloomberg. I'm Bonnie Quinn. This is Bloomberg Real Yield. Time now for the auction block, where we look at issuance for the week. We start with Treasuries, where we saw a 20-year and 10-year TIPS auction. The 20-year sale posted a yield at the lowest level since last October. Meanwhile, the TIPS sale saw demand fall short of expectations, the lowest since 2022, in fact. Over in high grade, AT&T and UBS led the way in sales, each with a $5 billion offering. There were a bunch of Yankee deals that helped push this week's volume above dealers' $30 billion forecasts. And in U.S. high yield, the supply tide rolls on. This week, DirecTV priced $1.6 billion, helping to drive the week's tally to nearly $12 billion. The month-to-date supply now nearly $29 billion. And sticking with credit, Earl Davis of BMO says there has been a shift.
Structural paradigm with lower credit spreads, tighter credit spreads. Having said that, it becomes very important to watch the defensive side of things, which active managers do, because if a company or something goes boo in the night, you want to ensure that you're in the right credit. So I think it's very important to look at that. We think structurally lower credits, tight credit spreads, but it increases the importance of what you're invested in.
Joining us now is Meghan Robson, head of U.S. credit strategy at BNP Paribas, and Richard Zogheb, head of debt capital markets at Citi. Very excited to have you both. So, a new structural paradigm or no, Meghan?
We think so. So we think it's a very positive backdrop for credit heading into the fourth quarter. So we have the Fed cutting rates now. When the Fed cuts outside of a recession, credit typically does really well. And I think what's unique this time is Powell came out this week and said he's willing to prioritize growth in terms of the dual mandate. And so we see potential for data to actually accelerate into rate cuts, which could be initially a great backdrop for the credit markets and risk.
Well, it's interesting, though, Richard, because Meghan actually sees spreads going below, what are they at, 72 now, 72 basis points, into the 60s, which is almost counterintuitive if the Fed is cutting. What do you see?
Look, I don't disagree. The issue we have is that you talk about supply, and there's been a lot of supply, but the vast majority of it has been refinancing in nature. And so we've seen no net growth in these markets for the last few years. And liquidity is incredibly strong. Macroeconomic conditions are fairly benign. There is not sure how low rates will get, particularly on the long end, but the environment feels fairly stable. Defaults are low, volatility is low, market seems to digest bad news pretty quickly. And so when you've got all of this demand and all of this liquidity and we can't create enough supply to meet it, spreads can only go in one direction.
Right. Well, OK, that's a good argument. So let me dive in a bit further. How do you go and get that supply? Because that's your job now, right?
It is.
I mean, is it from M&A? Will we see that pick up?
So look, we definitely would like to see M&A pick up. I think, and activity has definitely started to really pick up late summer into the fall. We lost a quarter of M&A activity in the second quarter because of the uncertainty following tariff day, right? And that set us back. Activity levels are picking up, and we expect to see a more active M&A market through the rest of the year into next year. That will create supply. That's going to take some time, right? We have to get the transactions agreed, we have to get them announced, and then they have to come to market. So in the short term, it's going to be very difficult to create supply, and it's really about convincing issuers that the market environment is so good, spreads are so tight that they should pull forward more of their refinancing and more of their capital expenditure financing needs.
Meghan, do you see anything changing this? Corporations just refinancing until the cows come home because they borrowed at such high rates that they're going to have to wait for a long time?
Well, for now, I think what's driving this really is, although you do have the Fed cutting rates, the 10-year Treasury, we expect to remain relatively stable. And so long-term borrowing for corporates, the cost of debt is still quite elevated relative to the past. So your incentives to really lock in rates are very low. And so corporates are looking at other avenues, the equity market. And if you look at gross leverage for the market, it's been relatively steady the past several quarters. And so you have that steady leverage, not much new issuance, and then you combine that with elevated yields. Demand for yield is still very strong. So those two, in a little bit of an imbalance, is what's really driving things here.
Richard, what about leveraged loans? I'm curious as to how Citi is approaching that, given that private equity seems to be just vacuuming up everything right now.
They're doing private equity is doing a lot of refinancing. And I think that's been really helpful for the leverage markets, because I think probably 18 months ago we came into the leverage markets and people were very worried about the maturity walls that were coming up because of the LBO boom we saw in 2019, 2020, 2021. Given how strong and the market has been, a lot of that maturity wall has been refinanced in the loan market and the high yield market. And the maturity walls are no longer a risk, they're a bit of an opportunity. So the leverage markets may be even stronger than the investment grade market, because the competition in the leverage markets from private credit is even more intense. And so I think not only are loan managers and high yield managers worried about the fact that most of the activity is refinancing, they're also worried that they're competing with private credit, and some portion of their market that they would expect to come to them is now going to go to private credit and will continue to go to private credit.
Yeah, it's fascinating, isn't it, Meghan? Because you would think that with rates starting now to come down, we don't know how fast the pace is going to be or how long it's going to take, but that, maybe leverage loans wouldn't be that attractive, but they seem to be still.
I think so. I think this cycle is a bit different in that you still have long end rates relatively sticky. And so you're not going to benefit by taking on duration risk and get that typical rally in yield. And so loans still offer you a pickup and carry relative to high yield. And I think what's also unique about the loan market compared to high yield is that triple Cs are still much wider in the loan market compared to sort of the lower quality part of IG versus and lower quality part of high yield. And so we think there's an opportunity in loans actually in selective triple Cs versus single B and double B, where a lot of refi has made higher quality much tighter.
I wish we had all day, but we only have time for one more. Richard, I have to ask you about the Apollo partnership. About a year ago, it started up, 25 billion of a partnership for the next 5 years. Couple of maybe little teething problems, but how is it going now? And, you know, Apollo is looking at other partners now too. Is that annoying?
Oh, no, look, we always expected Apollo to have multiple partnerships, right? This was, and our partnership is, you know, is targeted. It's direct lending. It's only in North America. And so we certainly expected Apollo would be looking at partnerships throughout the world in different asset classes. And you know, success with us, we thought would breed more success. So we love our partners at Apollo. We're working with them quite well. It took us a little longer to get it going. We made the announcement, and then it took a little bit of time to just work out the kinks and have the logistics. It's actually been wonderful. We're bringing it to our clients. It's accomplishing exactly what we hoped it would accomplish, in that it gives us the ability to go to our clients and say, Citi has one-stop shopping. If you want something in the broadly syndicated market, great. If you want something in the private credit market, we can offer that as well. So we're very pleased with how it's operating.
Yes.
We would like to see more volume go into it. I think the only reason we haven't seen more volume go into it is the public markets, the broadly syndicated markets are so strong. It's hard for private credit to compete right now.
All right.
But we feel great about it.
All right, well, this is what keeps us all in business. So thank you to both of you. That, of course, is Richard Zogheb of Citi and Meghan Robson of BNP Paribas. Still ahead, the final spread the week ahead. We'll be looking at the Fed's preferred inflation gauge on deck next week, along with high-level officials attending the UN. This is Real Yield on Bloomberg. Time now for the final spread the week ahead. Coming up Monday, a lot of Fed speak, including more remarks from Fed Governor Myron. Tuesday, President Trump will speak at the United Nations General Assembly. Wednesday, we get fresh data on U.S. new home sales. Thursday, more U.S. GDP and more Fed speak. And Friday, that all-important U.S. PCE data, the Fed's preferred inflation gauge. From New York, that does it from us. This is Bloomberg.